Welcome to the most comprehensive video ever created on order blocks. If you're a trader looking to improve your trading skills, enhance your strategy, and trade with precision, this is the ultimate guide you've been searching for. Whether you're a beginner or an advanced trader, this video dives deep into every aspect of order blocks and how you can use them to achieve a higher success rate in trading. For the sake of this video, multiple backtest was carried out on order blocks. Stick around to find out our discovery on why order blocks fails and works. We're diving deep into what order blocks are, why they're important, how to identify them, and most importantly, how to trade them effectively. And by the end, you'll have the tools and knowledge to improve your trading to the next level. Let's dive in. Firstly, what are order blocks? Order blocks are not just zones on a chart, they're institutional footprints. Big players like banks, hedge funds, and market makers execute trades so large that they can't fill them all at once. Let me simplify. Imagine a bank wants to buy $1 billion worth of your USD. They can't buy it all at once, or the price would spike immensely. Instead, they build their position over time in specific zones. This zones, where they accumulate or distribute orders, is what we identify as an order block. Order blocks are the key to understanding where smart money operates. They explain why the market reacts to certain levels with such precision. Order blocks form because of supply and demand imbalances. Institutions create these imbalances when they dominate the market. And this is important for retail forex traders. Here's why. 1. Insights into institutional activity. Order blocks reveal the footprints of institutional players like hedge funds and banks, as this is where they execute bulk orders, creating high probability areas for price movement. Understanding these zones allows retail traders to align their trades with smart money rather than being caught in traps. 2. Anchor point for trend continuation or reversal. In a variation where order blocks and supply or demand zone are represented by same candlestick, order blocks act as anchors that define key pivot points in market structure. When price returns to an order block, it often confirms whether the trend will continue or reverse. For example, a respected bullish order block signals the continuation of an uptrend. A broken bearish order block may turn into a bullish breaker block, signaling trend reversal. This clarity helps traders adjust their strategies dynamically based on price behavior around these zones. Number 3, precision in entry, exit, and risk management advantage. Order blocks provide traders with a strategic advantage in precision entry, exit, and risk management, unlike traditional support and resistance, by revealing the exact price levels where institutional orders were placed, allowing traders to align their entries with smart money, minimize drawdowns by placing stops beyond key liquidity zones, and maximize profitability by targeting areas where price is likely to react strongly, ultimately leading to higher probability trades with well-defined risk-to-reward ratios. Moving on, there are 5 major types of order blocks, which are 1. Bullish order block. This is found at the base of a strong bullish move. It indicates areas of institutional demand, usually a bearish candle before the impulsive upward move or rally. 2. Bearish order block. This is found at the peak of a strong bearish move. It indicates areas of institutional supply, usually a bullish candle before the impulsive downward move. 3. Mitigation order block. This is revisited zones where institutions mitigate or balance previous unfilled orders, often leads to sharp reversals upon retesting. 4. Continuation order block. Found in the middle of a trend where institutions reload their positions, indicates trend continuation with minimal retracement. 5. Breaker order block. A failed order block where price moves in the opposite direction, used as a reversal zone in trend trading strategies. Next, there are 4 steps in which I personally use in identifying high-probability order blocks from our backtest discovery. Before we continue, don't forget to subscribe, like, share, and drop a comment. Moving on. 1. A clear market structure. Before identifying an order block, ensure the market structure is well defined. This means identifying whether the market is in an uptrend, categorized by higher highs and higher lows, or in a downtrend, categorized by lower highs and lower lows. A strong order block typically forms at a key structural turning point, such as a previous demand or supply zone where institutional traders have entered large positions. 2. there should be a liquidity sweep. The market often takes out liquidity that is stop hunts or fake breakouts before reversing. This happens when price moves beyond a key high or low, triggering stop losses and trapping retail traders in the wrong direction. A valid order block usually forms after liquidity is taken because institutional traders use this liquidity to execute large orders before price reverses. Just as in the cases of the above examples, point A in all three examples is classified as a tradable or high probability order block due to sweep of liquidity during mitigation, its formation and mitigation respectively. We look more into liquidity on our future videos, so stick around. Next, 3. There should be an imbalance. An imbalance, also known as an inefficient price move or fair value gap, FVG, occurs when price moves rapidly in one direction with little to no retracement, leaving behind unfilled orders. This happens because institutional traders place large orders, causing price to move aggressively. A valid order block should be positioned near or within this imbalance, as price is likely to retrace back to this area to fill pending institutional orders before continuing in the intended direction. 4. It should lead to a break of structure. A break of structure, BUS, occurs when price decisively moves beyond a key swing high or low, confirming a shift in market direction. This break signifies that institutional traders have injected enough momentum to invalidate the previous high or low. For an order block to be of high probability, it should be the origin of the move that caused the BOS, indicating strong institutional involvement and increasing the likelihood of price revisiting the order block before continuing in the new trend direction. When trading order blocks, the most important aspect is confirmation, ensuring price reacts as expected at the predefined order block before entering a trade. Below is a structured, professional approach to using various entry models, including where to place stop losses and profit targets to optimize risk management and trade execution. First on the list, 1. Candlestick confirmation, multi-timeframe approach. When price reaches your identified order block, OB, on a higher time frame, e.g. 4 hours, you refine entries by dropping down to a lower time frame, but not too low, should be a significant time frame to the prior time frame, such as 1 hour, as this is a good time frame for using candlestick confirmation model. And look for a high probability reversal candlestick formations, such as bullish engulfing, bearish engulfing, and pin bars, hammer or shooting star, indicating strong rejection of the zone. Entry. Place a trade immediately after the candles close. Place your stop loss few pips above or below the confirmation candlestick respectively, and target first take profit at a structural high or low, then use a trailing stop to capture more profits. 2. Change of character. After price taps into the order block on the 4 hours or daily time frame, we move to a lower time frame for refined entries such as the 15 minutes, then watch for a change of character. A break in the minor trend, which is higher highs and higher lows to lower highs and lower lows, or vice versa. Look for entry through momentum candles or aggressive rejection moves. Entry. When price breaks structure on the lower time frame, enter on a retest to the newly formed order block on the lower time frame, and place your stop loss FUPS bono 4 below the low or above the high of the newly formed structure. Then target the opposite major order block, support or resistance as take profit. 3. Reversal patterns such as double top for shorts and double bottom for longs. A double top forms when price fails twice at a key resistance level, signaling a potential reversal to the downside. Likewise, a double bottom occurs when price rejects a key support level twice, indicating a possible bullish reversal. How to trade the pattern. First, identify the order block on the 4 hour or daily time frame. Next, drop down to the 1 hour chart and look for the formation of a double top or bottom. Wait for price to break the neckline or key zone before moving to the 15-minute time frame for a retest. Once price retests the neckline, look for a confirmation candlestick in the direction of the expected trend. Enter the trade after the candle closes, with a stop loss placed a few pips above or below the last swing high or low of the move. For take profit, target the next major resistance or support level. Important rule for validity: the second peak or shoulder of the double top should not have any candle's real body close above the first peak's high. Similarly, for a double bottom, the second low should not have a real body close below the first low. This ensures the pattern remains valid and prevents false breakouts. 4. Trendline break and RSI divergence. As the name implies, this method combines trendline breaks with RSI divergence for added confirmation. How to trade this setup? First, draw a trendline connecting the recent highs or lows. When price mitigates the order block on the 4-hour time frame, wait for a break of the trendline. Drop to a lower time frame, such as the 15-minute chart, and enter on a retest of the trendline or a previous high or low that has been broken. Adding RSI divergence for extra confluence. While price may be making a higher high on the 4-hour time frame, the RSI should be making a lower high. This signals momentum weakening and increases the probability of a trend reversal. Entry in risk management. Place a stop loss a few pips below or above the key zone to protect capital. Target the next support or resistance level for take profit. Use a trailing stop to capture extended market moves. Moving on, let's apply some of these concepts on a live chart for deeper understanding. Here, on the gold USD 4-hour time frame, the market is in a clear uptrend, forming higher highs and higher lows. Following our order block identification method, we mark out key bullish order blocks, which is represented by the last bearish candle before a bullish move that led to a break of structure, and because market is bullish, we're only looking for buying opportunities. So we have identified 4 order blocks, but we must apply our 4 rules for high probability zones, which are 1. A clear market structure. 2. A liquidity sweep during the formation or mitigation of the order block. 3. An imbalance. 4. A break of structure, BOS. Upon closer examination, we can see order block 1 lacks liquidity and imbalance, making it invalid as the market might use it for a liquidity grab or inducement, and for a zone to be valid or tradable to me, it should have at least 3 of these rules, though I prefer it having the 4 as market is based on probabilities, so you should always go for the highest of probability setups. Next, order block 2, a continuation order block, which has imbalance, a break of structure, and is in a clear trend. However, it currently lacks a liquidity grab, but an inducement zone above may add liquidity before mitigation, making it a high probability order block. Order block 3 is similar to order block 2 and remains valid. Order block 4, though at the origin of the move, lacks fair value gap, FVG, and has been partially mitigated, so it is only relevant if price fails to respect order blocks 1 to 3. Moving on, we focused on order block 2 and 3 where we expect price to react from on mitigation and continue its bullish trend. As predicted, market swept order block 1 and mitigated order block 2. Confirmation and entry. We refine our entry strategy by moving to a lower time frame, such as the 1-hour time frame. Using the candlestick confirmation entry model, we wait for a bullish signal. Initially, the market formed an indecision candle, which is not a valid entry signal. However, moving forward, a bullish engulfing candle appears, signaling a buy opportunity. Remember, trading is about protecting your capital by taking appropriate risk. So, for risk management, if your risk plan allows, you can enter immediately and place your stop loss below the newly formed support. And if your risk management plan does not allow this, set a limit order closer to support for a better risk-to-reward ratio. And wait for market to tag you in, but if doesn't, then you can re-enter after the next break of structure or wait for the next trade. Eventually, the take profit target was hit. Let's look at another entry model example on a live chart. Here on EUR/USD 4-hour time frame, the market is in a downtrend, forming lower highs and lower lows. Without wasting much time, let's mark out the order blocks using our principles. 4 order blocks were identified. Just like in the previous example, marking our order blocks, we found out order block 1 has no liquidity sweep during its formation or any zone for inducement before it can be mitigated, and it's also not the origin of the move that led to break of structure, so it will probably be used as a liquidity zone, making it an invalid trading zone. Order block 2 has imbalance, mitigated order block 3, which originated the move that led to the boss. Market is in a clear trend, and it has order block 1 before it, which will serve as inducement before its mitigation if price decides not to respect order block 1. Then this makes order block 2 a high probability zone for price to respect when mitigated. Order block 3. Though it's been partially mitigated, it's the origin of the move that led to boss. It has swept internal liquidity, it had imbalance, market is a clear trend, and that makes it valid. In cases where I have two valid zones in a close range, I mark them together as my POI, point of interest, as market could sometimes mitigate order block 2 and start going bearish, and sometimes it will mitigate both. Order block 4, being an extreme order block, is only relevant if price bypasses all other valid zones. Moving on, price failed to respect order block 1 and mitigated order blocks 2 and 3. For this example, we will be using the reversal pattern entry model, double top. So we now refine our entry by going to a lower time frame. Switching to the 1 hour time frame, we see market has printed several candles and also a shooting star candlestick pattern, which is a valid entry indicator. But we are focusing on the double top pattern for this example. The market forms the first peak or shoulder, then retraces. For a valid double top, note the second peak should not close above the high of the first peak or shoulder with a candle's body. It can have a wick go above it, but shouldn't close with a real body above. Aggressive traders may enter on the formation of this bearish momentum candle, but conservative traders should wait for a break of the neckline. Next, on closer examination, price also forms a trend line, which is already broken, adding confluence to this trade. For precise entry, we shift to the 15-minute time frame and wait for a retest of the neckline, then enter on a rejection or formation of a momentum candlestick in the direction we expect price to move, while stop loss is placed few pips above the last swing high, and we target the next major support for take profit. Like I would always say, make sure you manage your open positions and secure partials when necessary. That doesn't mean you should marry your trade. Give your trade room to breathe. Moving on, let's use this same setup for another example to explain the change of character entry model. Before we continue, don't forget to subscribe, like, comment, and share. Here on Euro-USD 4-hour time frame, market is trending bearish, so we're looking for only selling opportunities. Price is already at our POI. For refined entry, we go to the 15 minutes time frame. On the 15-minute time frame, the market is initially bullish, forming higher highs and higher lows. Upon reaching the point of interest POI, price reacts and forms another high, grabbing liquidity. To confirm a change of character, we now want to see a lower low instead of a higher low. Once the market forms a lower low, it signals a trend shift from bullish to bearish, which market eventually did, and 2 order blocks formed in the process. To ensure we do not miss the trade, we set a sell limit at the closest order block, place our stop loss a few pips above the second order block, and target the next major support level for take profit. But if your risk management plan doesn't allow you, then set a limit at the second order block and wait for price. Do not chase after trades. Eventually, take profit was reached. That concludes today's masterclass on order blocks. Mastering this concept takes time and practice, so keep refining your skills and always backtest your strategy for confidence. If you found this lesson valuable, don't forget to like, share, and subscribe. Let's master the market together. Drop your questions in the comments and let's continue the discussion. Thank you for watching and happy trading. From DMFX Trading School.